Welcome back to Investinality, your go-to resource to weather all market conditions. Today we're going to be going over the EPS ratio. I'll walk you through what it stands for, how it's calculated, some clarifying examples, and some of the limitations to take into consideration. So let's get to it. Now, before we begin, I want to make it crystal clear that the content provided in this video is solely for educational purposes and should not be considered as financial advice. The views, opinions, and strategies presented herein do not constitute recommendations to buy, sell, or hold any securities or investments. Investing involves risk, including the potential loss of principal, and past performance is not indicative of future results. And viewers are encouraged to conduct their own research and consult with a qualified financial advisor or professional before making any investment decision. The presenter of this video is not liable for any financial decisions made by viewers based on the information provided. Each individual is responsible for their own investment choices and should carefully consider their financial situation, risk tolerance, and investment objectives before proceeding. By watching this video, viewers acknowledge and agree that they are solely responsible for any investment decisions they make and that the presenter and this channel bear no responsibility or liability for any outcomes, gains, or losses resulting from such decisions. Okay, now let's get to it. So to begin, let's go over the definition of the EPS ratio. Now, EPS stands for earnings per share. It emphasizes the profitability on a per share basis. In other words, this is the earnings for one share of a stock. The earnings refers to the total earnings or a company's net income. Shares is the number of outstanding shares, which is the total number of shares available to be traded in the open market. Great, now let's walk through the calculation of the EPS. The EPS is equal to a company's net income divided by the number of outstanding shares available to be traded in the open market. Now let's walk through some examples to clarify this concept. Imagine we have company XYZ. Company XYZ has a net income of $10 million and 5 million shares outstanding. Given our formula of net income divided by number of outstanding shares, company XYZ would have an EPS of $10 million divided by 5 million shares, which is equivalent to $2. Now what does this really mean? This means that on average, this company is making $2 in profit for every single share of its stock. Now, why would this be useful to know? Well, let's look at a hypothetical example. So let's consider company A, which has an EPS of $2. On the other hand, we have company B, which has an EPS of $5. Although it might not seem like that big of a difference, company B is actually making more than 2 times as much as company A. All else being equal, this makes company B be a more enticing investment option as compared to company A. Now, something to take into consideration with the EPS is that it does fluctuate on a quarter per quarter basis. Let's take a look at how this could impact the profitability of a stock over time. The first example I'll go through is this hypothetical company. This company has a fluctuating EPS. So for example, from before 2000 to 2000, the EPS is on a somewhat steady increase. After 2000 until 2005, the EPS decreases, and this rise and fall can be seen to be consistent over time. On the other hand, let's consider another company whose EPS starts low, around 0.5 before 2000, and it gradually increases until approximately 2014, and afterwards the EPS starts declining. This is a case where we can see a more gradual trend and a gradual change in direction of the EPS. The importance of this is seeing that certain companies have fluctuating EPS, in which case certain years or quarters may tend to be more profitable for the business as compared to other businesses where there's a gradual change over time, making the prospect of a long-term profitable investment more likely. Great, now that we've gone through that, we also have to consider some of the limitations the EPS ratio has. So 2 of the limitations I'll go over are the earnings quality and the ability of a company to manipulate the EPS. So regarding the earnings quality, certain values that go into the earnings are controlled by the company, in which case if a company misrepresents the amount of earnings that it's making, the EPS would not be a reliable metric of how well the company is actually doing. On the other hand, there's also the concept of EPS manipulation. What does this mean? Well, EPS is earnings per shares. Now, a company is in control of how many shares are out there in the open market. A company would be able to manipulate their EPS by changing the number of shares. Imagine that we have a consistent earnings value, but the company decreases the number of shares. In this case, the EPS would be increased. On the other hand, imagine again we have a consistent earnings value, but a company increases the number of shares. In this case, the company would be able to decrease its EPS. Great, and there you have it. We've walked through the definition, calculation, walked through some examples, and considered the limitations of the EPS ratio. Thank you for watching. Remember to hit that like button and subscribe to our channel on YouTube. I'll have more videos coming up on other investment terms. And make sure to leave a comment with any other terms you're interested in. I'll take a look and consider that for my future videos. Until next time.